Welcome to The Explainer. Today, we're unpacking a hidden financial mechanism that quite literally threatens the stability of the entire global economy. It's a ticking time bomb, and it's nestled right in the heart of Tokyo. We're talking about something that impacts everything, from your personal retirement account to the interest rate on your everyday mortgage. We're diving deep into the unraveling of the yen carry trade and Japan's impossible debt trap. Let's get right into it.
Okay, let's dive into this with a number, 12.4%. That was the absolutely historic, terrifying plunge of Japan's Nikkei index on August 5th, 2024. To put that massive drop into perspective, it was the worst single-day crash the Japanese market had seen since the infamous Black Monday way back in 1987. In a flash, trillions of dollars in global wealth were just vaporized.
But here is the central mystery we are going to solve today. Why did a microscopic fractional interest rate hike of just 0.25% by the Bank of Japan trigger a worldwide financial bloodbath? I mean, how could such a tiny tweak over in Tokyo send massive shockwaves through tech stocks in Silicon Valley and crypto markets all around the globe?
Well, to understand the underlying disease here, we first need to look at the immediate symptoms. Section 1, the August 2024 shock.
So, on July 31st, the Bank of Japan nudged its interest rates up to 0.25%. Just days later, the dominoes started falling. The Nikkei plummeted 12.4%, but it didn't stay confined to Japan. The U.S. S&P 500 fell 3%. Crypto markets, we're talking Bitcoin, Ethereum, plunged 20% in just a matter of hours. Even the VIX, which is Wall Street's famous fear gauge, spiked above 60. It was like a giant fire sale. Literally everything was liquidated simultaneously.
To figure out how these seemingly disconnected markets are actually hardwired together, we have to uncover the hidden financial plumbing. Section 2. The yen carry trade explained.
Now, the yen carry trade might sound complex, but it's actually incredibly simple. It's basically the practice of borrowing in a low-yielding currency, in this case the Japanese yen, to invest in higher-yielding assets somewhere else. For over 25 years, because Japan's interest rates were parked at or even below zero, global investors essentially treated Japan as their own personal, giant, free ATM. Not a bad deal if you can get it, right?
Let's move to and see how this builds, because this is the simple, highly leveraged math that fueled global growth for a generation. Step 1. You borrow Japanese yen at practically 0% interest. Step 2. You convert those yen into US dollars. Step 3. You use those dollars to buy high-yield assets. This could be U.S. Treasuries paying 4% or high-flying tech stocks. And step 4, you simply pocket the profit margin. It was free money as long as the yen stayed cheap and rates stayed at zero.
And let me tell you, investors didn't just do this a little bit. The estimated size of this global trade is a staggering $3 to $7 trillion. To put that into perspective, that is the size of entire national economies. We're not talking about a minor niche strategy used by a few rogue traders. The yen carry trade became a foundational pillar of modern finance. It funded everything from emerging markets to massive corporate expansions.
But as we're seeing, the era of free money is forcefully coming to an end. Section 3. Japan's impossible debt trap.
Following the massive burst of their economic bubble in the 1990s, Japan desperately needed to stimulate its economy. So in 1999, the Bank of Japan introduced unprecedented 0% interest rates. The whole goal was to get Japanese citizens to borrow and spend. But instead, the rest of the world swooped in and borrowed those cheap yen. Fast forward to 2024, and with domestic inflation finally biting hard, the Bank of Japan was forced to hike rates to 0.25% just to fight rising prices.
And this puts the Bank of Japan in a terrifying, truly no-win scenario. Think about this. Japan's national debt is over 240% of its GDP. If they raise rates to defend the plunging yen, servicing that absolutely massive debt becomes impossibly expensive, risking a domestic debt crisis and a market crash. But on the flip side, if they keep rates at zero to defend the budget, the yen collapses, leading to hyperinflation for a country that actually imports most of its energy and food.
One of the experts in our sources described this precarious situation perfectly. They said, "It's like drinking alcohol every day and pretending you're not an alcoholic." For decades, the global financial system has basically been living in denial, drunk on artificial, long-term, cheap money. Well, now reality is finally showing up, and it's bringing a massive, very painful hangover.
The real climax of this story, though, involves much bigger, slower players. Section 4. The Great Repatriation.
You see, it's not just fast-moving hedge funds unwinding their trades.
Massive Japanese pension funds and life insurers are bringing their capital home. Japan holds $3.7 trillion in net foreign assets. This is the slow money. And as this colossal amount of money systematically flows back to Tokyo, it represents a massive, inevitable drain on global liquidity.
Now, what's really interesting about this slide is the sheer math driving this capital exodus. When you factor in the costs of hedging against currency swings, U.S. Treasury yields for a Japanese investor have actually dropped below 1%. Meanwhile, domestic 30-year Japanese government bonds are now yielding over 3.4%. So, financial giants like Daiichi Life and Nippon Life are logically reducing their foreign bonds and shifting capital back to domestic Japanese assets. After decades, they can finally earn a safe return right at home.
So, what does a Japanese insurance company buying domestic bonds have to do with you and your wallet? Let's dive into Section 5, Global Financial Contagion.
Japan is one of the load-bearing walls of the entire global financial system. When that wall starts to crack, the structural integrity of everyone's financial house is threatened. The shifts happening over in Tokyo definitely don't stay in Tokyo.
You see, global economic growth is already highly vulnerable. The baseline forecast is hovering dangerously close to the recession threshold right now. The sudden withdrawal of trillions of dollars of Japanese liquidity from the global markets could severely exacerbate these downside risks, tightening financial conditions precisely when the global economy is looking incredibly fragile.
So the crucial point is the mechanical doom loop this creates. Japan holds over $1.1 trillion in U.S. treasuries. If they start selling those treasuries to bring money home, it pushes U.S. yields higher to attract new buyers. Higher U.S. yields tighten global credit conditions. Suddenly, it's way more expensive for an everyday family to get a mortgage or for a corporation to get a loan, and the contagion hits equities worldwide. The era of free money is just gone.
Which leaves us with one final, very unsettling thought. For decades, the entire world relied on Japan's 0% interest rates to fund its growth. But when the world's largest creditor pulls its money home, who will fund the global economy? Thanks for joining me on this explainer. I really hope this helped you see the bigger picture. We'll catch you next time.